Good afternoon, all. Thank you so much for joining in. Uh, Welcome to the India Factoring Chat Show, Factoring One Stop Solution for all your global aspirations. I am Rajesh Rastogi, your host for the chat show today. Before we welcome our esteemed speaker, allow me to provide you an overview about India Factoring first. So, India Factoring offers working capital solutions through factoring product aimed at converting your receivables into cash. The company is a subsidiary of the European bank FimBank PLC Malta and is registered with the RBI as an NBFC factor. India Factoring is also 83 category authorized dealer. We started our operations in India in 2010, and through our global network, we offer one-stop solutions around receivable finance. For the past 6 years, we have held the top position in India in export factoring in India. Additionally, we have garnered recognition through numerous national and international awards, including accolades such as Best Receivable Finance, being ranked among the top 25 safest places to work, and receiving the prestigious FCI Best Deal of the Year, among others. Now, I would like to invite our esteemed speaker, Mr. Jaspreet Singh, and allowed me to introduce himself. So, Mr. Jaspreet Singh is a seasoned professional with expertise in payments, trade finance, factoring, and supply chain finance. His diverse experience spans various sectors and industries, so showcasing his versatility and adaptability. Mr. Jaspreet's keen understanding of international transactions in trade finance and his proficiency in optimizing cash flow and mitigating credit risk in factoring highlights his expertise. Additionally, over the last 7 8 years, Sir has been deeply involved in the supply chain finance with focus on enabling access to credit, especially for the undeserved MSME sector in the country. Mr. Jaspreet's commitment to professional development and staying updated with the industry trends makes him valuable asset in the discussion related to finance and trade. We welcome you, sir.
Thanks, Rajeshi.
A very good afternoon, sir. How are you doing?
Very well. Thank you so much, Rajeshi, for organizing this.
Thank you so much for sir taking out time and discussing a lot of things. So, sir, I'll directly start off with some of the questions which actually our audience is also waiting a lot. And today we would be discussing about a very important topic in which actually you have also worked a lot, and this is like the need of the hour today, which is risk mitigation, right? So if I talk about risk mitigation, let's say in trade receivables, it's crucial today, and for multiple reasons, like if I'll say financial stability, operational continuity, or let's say competitiveness to avoid non-payment or delayed payment risk. It's pretty important today. I want to understand from you as an expert, like what are the three primary tools we can use to mitigate risk associated with trade receivables in the current scenario?
Thanks. So, Rajeshi, let me break this into two parts, right? You can make this concept or topic as complicated as we want, right? But I think in the interest of the larger community, I think I want to start from the most basic things that suppliers can do, right? And this is very valid for the Indian context. First and foremost, something that suppliers are shy about, specifically given their size and standing against large buyers. But I think the first and foremost option available is asking for advance payments or deposits, right? And they can ask for this before fulfilling orders. That significantly reduces the supplier's exposure to credit risk, because payment is happening before delivery of goods. But it purely depends on the supplier standing against the buyer. We've seen that this is prevalent where suppliers are large size big players, right? The second most important aspect, and it shouldn't be very complicated, is assessment of credit of buyers, right, before deciding to trade with them, and potentially monitoring the health of buyers, right. uh, these credit assessments can be a very important element before one decides to access or give out credit to customers, right. Ongoing monitoring of credit worthiness of buyers is also a very important sign. It helps you with early alerts, and maybe take proactive risk mitigation measures. For example, if you've done a trade of $100 with one buyer, and during the course of not having realized that money, that you realize that the buyer's credit worthiness is going down, you may not want to trade on the second time, putting your second
Right.
shipment at risk as well, right? So that's the second very simple element. The third element, that also, it depends on whether suppliers can effectively negotiate this, is contractual protections, right? Suppliers always have the option of putting out contractual obligations on buyers and taking control back, such as retention of title, right? Or potentially putting in penalty for late payments. These will obviously help safeguard the supplier's interest and provide some bit of recourse in the event of non-payment, right? Now, coming to slightly more complicated structures as against the ones that I spoke of, credit insurance is a very, very important element now. Suppliers can purchase trade credit insurance to protect against non-payment or default by customers. It is a great way of enabling financial compensation in the event of insolvency, protracted default, political risk, right? That a lot of suppliers that work with customers overseas deal with, and it will help minimize the impact of bad debt on the supplier's cash flow. Credit guarantees also is always a great tool, and these are usually provided by financial institutions or government agencies. The more popular ones being ECGC, CGT, MSME, and India Factoring also, for that matter, right, where suppliers can receive payment even if the buyer defaults. These guarantees obviously enhance credit worthiness of the buyers and are a great tool to extend credit terms while doing business. One more element, this is taking off very well now, both locally and on the cross-border side, is factoring. Also very, commonly known as receivable financing. This obviously involves a supplier selling the trade receivable to a third-party financial institution, also called a factor, at a discount in exchange for immediate cash. Uh, the benefits that factoring offers on the balance sheet side is that the suppliers can convert their receivable into cash quickly, and because this is under certain non-recourse structure mostly, it reduces exposure to credit risk as well. I want to also speak about two more elements that are very, very popular. One is obviously supply chain finance, which enables suppliers to
Right,
access financing based on the strength of their buyers, not just their own credit worthiness on a standalone basis. And
right,
this is slightly favorable than bilateral lending from financial institutions. It helps you reduce the need for collateral most of the times, and will reduce the need to rely on your own credit worthiness. And the last one that I want to bring about is letters of credit. The very, very commonly seen now both in local and cross-border transactions, where suppliers can take an irrevocable letter of credit or a guarantee from the issuing bank instead of a buyer. And that means that you're reducing the risk on the buyer in case of non-payment. And as long as you're supplying the goods and submitting documents in line with the letter of the credit, you stand a guarantee from the issuing bank or the confirming bank to get your payment. I think these are some of the tools that are very, very commonly available and should be used by suppliers. And I think implementing a robust risk management practice can help suppliers mitigate these risks.
right, right. So very rightly addressed. As I was going to ask only about credit insurance and guarantees, which you actually pretty rightly mentioned. So in a nutshell, we actually know that the risk tools are pretty important, and especially when we look in the industry, they actually play a very major role. Uh, I also wanted to understand. So, for example, like Unilever in the industry use credit insurance, and let's say Nestle uses letter of credit, which you mentioned. Coca-Cola uses currency hedging, and many more. However, sometimes what I think, and what might of the a lot of people might think that there's some instances where organizations actually rely a lot on these tools, and this can also create a false sense of security. uh, I want to understand, like, how can organizations prevent over reliance on specific risk mitigation tools from affecting the overall risk tolerance they have in an organization.
Thanks. So, Rajesh, I think it's a very underrated aspect in all of trade finance today. And I see this not just with small local businessmen, but even sometimes big businessmen in India and, counterparties that trade with customers overseas, right? Uh, the most important aspect is that one needs to understand the credit risk that they're exposing themselves when deciding to deal with a certain counterparty, right? At this point, I'd like to talk about why it is so imperative that businesses have a risk management approach, right? Most suppliers today, and I'm sure you guys hear this often in the market as well, that they don't have any credit assessment process only for their customers, right? The need to understand the buyer's financials, profitability, cash reserves, and while sometimes these information items are available publicly, but most suppliers do not know where to look for, or are sometimes to even shy to ask the customer because उनको लगता है कि business impact ना हो जाए, customer नाराज ना हो जाए, right? So those are some of the things that are very important, but suppliers are shy to ask for them, right? Internal controls such as setting up credit limits on a buyer, right? Or monitoring that on a regular basis is a very, very good practice. And these should be the first and foremost aspects to be reviewed before any supplier goes for any instrument, such as a credit guarantee or a factoring structure, etc. And I have also come across suppliers where sometimes none of this information is available to the suppliers. But even in that case, evaluating factors such as the lineage of the buyer, right? Length or years of relationship with some other similar suppliers in the industry, whether the business owner is a first generation or a second generation, right? Uh, Doing some very simple Google checks to understand adverse information on the buyers, speaking to a past supplier, right? Past incidents of fraud, etc. अगर आपको कोई भी ऐसी information, financial information नहीं मिलती, even if you check some of these hygiene aspects, these are also very important elements to check and are overlooked by small. I have come across suppliers who could have easily Googled about a buyer and realized that the buyer is not a great credit risk to take, but they went ahead and did business. So, if you can't do complicated assessment of credit, underwriting, creating limits, doing some very basic hygiene checks is also some aspects that suppliers could look at.
Rightly said, sir. So I think that's a pretty great point, which actually now the nitty-gritties have so so dense in these days. Like we actually miss out on the basic parts, and which is very rightly mentioned by you. Uh, Another area would I would like to touch upon, which is actually close related with risk mitigation, is trade finance. So trade finance impacting the overall macroeconomics of the country. According to you, in relation to trade finance, in your views, how can trade finance support the development of, let's say, SMEs, small and medium enterprises, which are engaged in international trade? So how can they be, they can monetize upon it?
Right. Now, so as you also said, right, probably trade finance plays the most crucial role in supporting SMEs and helps them engage in international trade,
Right,
primarily by helping them access financial services and mitigating various risks, right? Let me explain the areas in more
right,
detail. First is obviously when you're an SME trying to do business, working capital support is also a very important area that one cannot overlook, right? Especially when engaging in international
right,
trade with longer payment cycles, shipment times are longer, payment cycles are also longer, right? Trade finance facilities such as export import financing, invoice discounting, and trade credit provide SMEs with the very important working capital to fulfill orders, purchase raw materials, and cover operational expenses, right? Risk mitigation, as we discussed also, such as using bank guarantees, credit insurance, letters of credit, also help a supplier mitigate various risks associated with international trade. Uh, we spoke about payment default, non-delivery of goods, currency fluctuations as well, right? These instruments provide assurance to both buyers actually also and sellers and reduce the uncertainty in and enhances trust, which is the missing element in most trade transactions, right? I think the third aspect is that it also helps SMEs to expand their reach and access new export markets. With the support of trade finance providers, SMEs can navigate complex trade regulations, comply with the detailed documentary requirements as well, and mitigate multiple other risks associated with cross-border transactions. And in return, it increases their competitiveness, right? One more element is supplier and buyer financing, right? Because working capital is required on both
right.
sides. Trade finance and
Both
solutions
sides,
such
yeah.
as supply chain finance are actually very vital in enabling some of this because even things like purchase order financing, which is a pre-shipment loan, that is very easily accessible through trade finance. It can help SMEs manage their cash flow by providing financing based on their trade relationship with buyers and suppliers, right? Like we said that it is based on sometimes the buyer's credit worthiness as well. So using some of these enabling solutions and optimizing working capital will help suppliers negotiate better terms with suppliers, and possibly fulfill sometimes large orders also without straining their liquidity. And one more element that I think gets unnoticed is capacity building and technical assistance, right? There are a lot of trade finance
Mm.
institutions such as yourselves, right? When you engage with smaller suppliers, you also help them in capacity building programs or technical assistance, right? We have so many institutions in the country who help run MDPs specific to certain sectors or trade corridors, which help them improve understanding of trade finance product, risk management practices, international trade procedures. And these initiatives empower businesses to take informed decisions, access financing, and navigate the complexities of global trade. Uh, One more subset of this is facilitating the trade documentation. A lot of institutions also provide SMEs in preparing the necessary trade documentation, because like in case of an LC, merely presenting the right document can assure you the payment. So creating the right documents, letter of credits, the right bill of lading, export import licenses, etc., is also very crucial. So trade finance, I think, plays a very vital role in enabling growth and sustainability of SMEs, especially in international trade, by
Right,
enabling financing, mitigation tools, market access, and technical assistance as well.
right, right, right. Another thing which I like to touch upon. So, as we today operate in a VUCA world, which actually stands for volatile, uncertain, complex, ambiguous, and the world is actually, is an ongoing change. It's totally dynamic these days. I would love to know some insights on the current trends of global factoring market. Like, what are the ongoing trends today we are having? What are the different things which the suppliers and the buyers are doing?
Thanks. So Rajeshi, as I think about this topic, a lot of points come to my mind, right? And the first and foremost is that the demand for working capital is not restricted to smaller businesses now, right? Even large companies across industries are seeking efficient working capital terms and solutions to support their operations and growth initiatives. And factoring provides businesses with immediate cash to, by accessing their AR and converting that into cash, right? So very important element and trend, that is something that I'm seeing globally with a lot of players, not just small businesses, right? The
Right.
second very prevalent trend I'm seeing is that suppliers are using expansion of their markets also using factoring, right? So a supplier based in India who does not understand LATAM, for example, or the local nuances of a Latin American market, with the support of factoring, they are able to access some of these markets. So factoring is gaining traction in emerging markets a lot more than developed markets, right? Obviously, this is driven by the number of SMEs, the globalization of supply chains, the improving regulatory frameworks, right? Countries like Africa, for example, are seeing significant growth in factoring, because as an outsider, when you look at factory business in Africa, you don't get that comfort. So factoring is used as an activity which will help you seek alternative financial options than traditional bank loans, right? Uh, the third aspect that or the trend I'm seeing is that there's a lot of technology driven innovation, right? Advancements in tech, particularly fintech, the digital platforms that we see globally, locally, are transforming the factoring industry, right? These platforms actually streamline not just the financing aspect of it all, but process of invoice submission, credit assessment, funding, and just overall make factoring more accessible and efficient for all sizes of businesses, right? Now we also hear about technologies such as blockchain and AI, are being explored to enhance transparency, security, automation. uh, Another trend is that the demand for non-recourse factoring is also going up, where factor assumes the credit risk of the debtor, and it's getting very popular because businesses are seeking additional protection against customer defaults, and this trend reflects the growing importance of risk mitigation and credit insurance in factoring arrangements, particularly in uncertain economic jurisdictions and environments, right? uh, and maybe I'll touch upon a couple more. I think supply chain finance is also getting integrated into the factoring overlay, right? It's uh,
Right.
end-to-end financing, risk management for businesses. And let me give you an example of, most cases factoring is done when the shipment has already happened, right? But if you integrate supply chain finance very early into the trade cycle, a supplier can access pre-shipment finance through, let's say, a purchase order finance through a supply chain structure, then shift the risk into a factoring like structure once the shipment has happened. So supply chain finance are also programs are also leveraging the credit worthiness and offering finer rates to some of these suppliers, which at the end of it all optimizes working capital and strengthens the supply chain relationships. And I think the last aspect is regulatory developments, right? We have seen a lot of developing markets rework their regulatory arrangements to come in line with become easier geographies to do business. And factoring amidst all of this is a viable alternative financing and driving market growth. uh, Implementing measures to enhance legal regulatory frameworks, uh, all of this is very very prevalent now, and I think the global market on the factoring side will continue to evolve in response to some of these changing economic conditions, technological advancements, and regulatory landscape. And I think the industry's resilience and adaptability will continue to make factoring a very, very valuable financing solutions, especially for businesses seeking flexible working capital structures.
Right. So before moving to another question, we have Prasanjit who actually says lovely insights, Mrs. Jaspreet. I was trying to associate the discussion points to my industry. So kudos to you, sir. Thank you, Prasanjit, for joining in. And so now I'll move to my next question, which is an interesting question, which might a lot of people want to ask. So we discussed about the SMEs, and SMEs, what today we think is a building block of the country. For any nation, SMEs is very important, and majority of SMEs are actually foraying into, despite operating in the country, they are also foraying into operations of impex, right? This is obviously great. One of the major doubts a majority of traders have these days is like the availability of trade finances, which actually differs across different industries, right? Like for let's say FMCG industry, trade finances are different, and let's say agriculture industry, uh, they are different, right? For example, are there specific challenges, let's say for agriculture exporters? I'm just giving an example, right? So, are there any specific challenges compared to the technology companies? So, what are the different techniques, availabilities, or what the nitty-gritties which you may say for acquiring trade finance for different industries?
Well, to delve deeper into the concept, right? Let's think
Yeah,
about how does trade finance happen, right? Trade finance is
correct,
actually a result of assessment of some elements of a business, right? For example, working capital cycles, right? Risk profiles, collateral requirements, and some of the market dynamics as well, right? Uh, let's talk about risk profile, right? So, agricultural exports, for example, right, are often perceived as higher risk due to
right,
factors such as weather conditions, right? Because is it frozen food? Will it continue to have the frozen temperatures? Price volatility, because some of these price controls are available in a lot of geographies. Regulatory uncertainties as well. We've seen that in case of agricultural producers, there have been some overnight bans in certain countries, right? So as a result, lenders are very cautious when providing trade finance to agricultural exporters. Maybe at the end of the day, it ends up being a very heavy collateral backed structure or risk mitigation measures, right? And in contrast, technology companies will have usually very stable revenue streams with lower perceived risks, making them easier to making it easier for them to access trade finance, right? The second element is collateral requirements as well, right? Because agricultural exporters will face some of these challenges that we spoke of, and the way the risk profile is evaluated by lenders, uh, their assets are also very much tied up with perishable commodities or crops, right? In such cases, alternative forms of collateral such as warehouse receipts, crop insurance may be required to access trade finance. Look at technology companies on the other side. It's potentially intellectual property or equipment that can be used as collateral, making it easier for them to secure financing. Uh, I can also very, very strongly think about seasonal fluctuations. right, which are very prevalent in agricultural exports, as against fluctuations in the technology market. And they obviously significantly impact cash flow and financing needs, right? Lenders will be very comfortable to provide trade finance during peak seasons, for example, but maybe hesitant to do this during off-peak periods. Like we spoke, technology companies usually have a stable, consistent revenue stream, so for them to access financing is very simple. Uh, One more area is regulatory barriers or market access, right? If you look back in history, you can very comfortably come up with areas where agricultural exporters were facing bans, but we've never heard so in the technology domain, right? Uh, if you talk about the Ministry of MSME and some of these uh, trade corridor discussions where trade terms are being discussed, you will always hear about trade barriers, tariffs, and regulatory restrictions to agricultural exports, but nothing from a technology standpoint. And I think that is why trade finance providers are very reluctant to extend credit into exporters potentially operating in high risk or politically unstable regions as well. Whereas technology
Right.
companies have it easier because they are usually seen as accessing global markets and far lesser actually few regulatory barriers when exporting. And I think the one of the most important aspects, and I think as a banker, as an assessor of risk, as an underwriter, or as a a decision maker on the financing side, I think it's very important to understand the supply chain complexity, right? Even if somebody is not an expert on tech, but has the basic understanding that for a tech export you potentially need a services portfolio, you need to create a product, and if it's a product company, then you need potentially a chip or a storage device and a software to be loaded on. And it's very easy to assess and come up with some framework of supply chain when it comes to a tech product, right? And the shipment, you can assume that it's not a physical shipment, so it will happen over internet, will potentially be downloading of a software, etc., right? But if you think
Right.
about an agricultural supply chain, it's very complex, very fragmented, multiple stakeholders. You have farmers, you have seed providers, you have processors, you have distributors, you have exporters, government agencies also involved. So the complexity can far exceed anything on the technology side, and risk of disruptions, payment delays, some of these aspects are sort of things that lenders look at very deeply and think very differently on the risk profile framework when comparing the two.
Right. So we actually have one of the questions from one of the viewers. So, Mr. Vinod Chaube says, "Hi, Jaspreet. Having multiple merits in the factoring services in India, factoring has still not got its due space as it has in Europe and America, which is true. Factoring in India is opted after exporters have exhausted their limits with the bank. Banks too have been giving factoring a least preference. This approach may not be this approach may not be of help of this product. What banks need to do in to promote this factoring in India? So, sir, what are your views on this?
Well, I think there are three, four very immediate aspects that come to mind, right? One is that for any local bank in India to understand the global factoring framework, the network is a very crucial play, right? If you look at some of the large Indian banks and talk to them about export factoring, it's not a very fructifying conversation because they have particularly focused on the local market dynamics, except a few banks who are also looking at cross-border businesses very actively, right? But
Right,
think of players like, let's say, India Factoring, right? And the kind of network that platforms like India Factoring have created for smaller suppliers to access some very difficult geographies as well, right? So comparing how banks have done in the factoring space, I think is completely ignoring the fact that a lot of players on the non-bank side have done a very tremendous job on the factoring side, right? So it's important to understand that whichever lender you access or reach out to from an factoring standpoint, uh, it's very important to think about what kind of global network they have established, right? And
right,
I'm very comfortable in saying this, that some of the non-banking institutions have done far better in creating that network. That's one. The second aspect is that uh, the ticket size of it all, right? Uh,
Right.
a lot of banks, and this is just the way this industry is. A lot of banks think about what kind of volume they will derive with one counterparty, right? If you are a supplier who's potentially going to export goods or services worth just 100K, I have seen that large banks are not very interested, right? That's second. uh, you know that there are so many institutions who are working on small ticket as well. I know many institutions who don't mind onboarding a customer who's also exporting maybe $50,000 of trade in a year, and he gets access, right? Whereas he's been denied that access with large banks, right? So that's the second aspect. And then the third aspect is that if you look at how foreign banks or multinationals look at cross-border factoring, you will see a very different picture, because they one have their own branch network. In most cases, a small supplier out of South India who's accessing or selling garments to Gap in the US could do this with a multinational bank more comfortably than a local Indian bank, right? So some of these aspects need to be thought of a little more deeply. And I'm sort of in sync with the query that this is still developing, but I think some smaller players, nimbler players, have understood this opportunity very actively as against some large institutions. So I think it will keep on improving and changing as we grow further.
Right. Uh, so we spoke about risk few minutes back, right? And also spoke about the VUCA world, right? Uh, Today, the world we're actually living is pretty dynamic. And when I talk about dynamism and this VUCA world, I actually remember one of the recent incidents, which is like, if I talk about the risk, is the global chip shortage, right? Events like these keeps on happening from time to time, right? And which actually disrupt the overall supply chain, your finances, your overall operations as well, right? In such cases, like how can these risks could be handled, and the finances related to these risks could be handled in such a way that it should have a minimal impact on one's business.
Thanks for that question, Rajeshri. And as I respond to some of your queries, I'm starting to get a feeling that essentially trade finance is more about implementing proactive risk management strategies, right? And
Right, right,
very very crucial for resilience in the supply chain. Let me give you a flavor of some of the aspects that I think are very important for this point of view, right? Number one, very underrated aspect, but diversification of suppliers is very very critical. I think a lot of large players have realized, specifically with the chip shortage, that diversification of suppliers is crucial. Relying on a single supplier for very critical components uh, can lead to disruptions due to shortage or other supply chain issues, right? Mitigating the risk by diversifying works well because you have a diverse supplier base. You can work with multiple stakeholders for key components, and also maintain strong relationship with alternative suppliers, right? uh, the second aspect is supply chain visibility or transparency thereof, right? Which is also something that we haven't seen much, especially on the cross border side, right? Enhancing visibility,
right,
transparency in the supply chain can help businesses identify risks in advance, right, and disruptions very early on. uh, we have quite a number of platforms which can help you implement supply chain monitoring systems, leverage data analytics, and foster collaboration also between suppliers by getting a sense of inventory levels, production capacities, potential bottlenecks. This will allow businesses to proactively manage some of these risks. Another very very not spoken of is inventory management and buffer stock, right? We have these popular concepts of just in time, etc., but I think you cannot ignore the fact that
right.
maintaining adequate inventory levels and establishing buffer stock for critical components at least can help businesses mitigate the impact of supply chain disruptions, right? Strategically managing inventory, maintaining a safety stock level will help you, ensuring continuity of operations during intermittent or long shortages and or unexpected disruptions, right? Very very pertinent now that supply chains are becoming more and more global. And I think two more aspects. The second last being collaboration and communication, right? Strong collaborative relationships with suppliers works well. Other stakeholders is essential for effective risk management. Open communication channels, regular meetings, collaborative problem solving, can help you facilitate some of these risks, and maybe enable swift responses. And I think at the end of it, technology and automation, right? Uh, Leveraging tech automation can streamline supply chain processes, add to your efficiency levels, enhance resilience, advanced planning, forecasting techniques, predictive analytics, and simply investing in digital solutions, digital supply chain solutions can help anticipate some of these demands, and reduce the risk on some of these industry events such as potentially chip shortages. But I think at the end of it all, it has to be a multifaceted and a proactive approach to help businesses.
Right. So we have another question from one of the viewers. Mr. Manoj Vasan asked, excellent session. Can you give us more light on recent FTAs signed by India and major benefits to Indian exporters? Any specific industry gains more, which have gained more benefits?
Well, I think I'm not very up to date on some of the most recent FTAs, but I do plan to put up a note on some of these aspects. So, Vinod, if you can just hold it and access this on LinkedIn, and I'll also share with the India factoring team for them to put it up. But there are some of these I'm still studying.
Right, right. You mentioned about technology in your last answer, which actually, with my next question actually dives towards that as well. That technology has been shaping the path forward, and every industry has been using technology these days, which has made the process more efficient, more reliable. What are your views on how artificial intelligence, which is AI, can be utilized to improve the risk assessment, fraud detection for the matter, or overall decision making in trade finances?
Right. So, while these are early days for, the overall impact that, techniques like, or, concepts like AI will bring about, but I think it can still be utilized in a lot of ways to improve, like you said, risk assessment, fraud detection,
Right,
deductions, and overall decision making, right? I think the first area is just data analysis and predictive modeling, right? We know, now that AI algorithms can analyze vast amounts of data from multiple sources, including transaction records, market trends, customer behaviors, and potentially identify patterns, and potential risks can be also predicted, right? By leveraging machine learning techniques, you can also create predictive models that can help you assess likelihood of default, fraud, and other adverse events, right? Enabling risk management and decision making. The second aspect is, I think, automating the risk scoring and rating. There are already AI powered systems that can help you assign risk scores or rating to customers or counterparties based on transaction data and predefined criteria or historical data, right? These risk scores can help you on the trade finance professional side as well, right? People who are underwriting, evaluating transactions, looking at paper documents, etc., by using these modeling techniques, can decide to focus on higher risk transactions or parties that require closer scrutiny, and not really waste so much time on the simpler transactions, right? You also spoke about fraud detection and prevention, right? I think
right,
uh, I have come to know, and I've read significantly, and also spoken to some large clients who are using AI algorithms to detect anomalies and suspicious patterns, which can indicate fraudulent activities very early on. And these include invoice fraud, identity theft, money laundering as well, right? By
right,
continuously monitoring transaction data, identifying deviations which are, not normal behavior, these systems are capable of flagging potential frauds also, and they do so in real time, right? Which is of vital importance, because
right,
then a supplier or a business can enable timely intervention and mitigate some of these measures. And I think two more aspects, one being credit underwriting and decision support, right? uh, while the most common form is underwriting or taking a credit assessment on the buyer on your own, but I think the AI models have come to help on some of these aspects as well, where you can create underwriting models which analyze a lot of borrower characteristics, financial statements, also credit histories, to assess credit worthiness, and potentially help a supplier negotiate more suitable and sustainable financing terms, right? They can help you
right,
underwrite, process, improve your accuracy, and provide decision making to even trade finance professionals, not just counterparties, right? And I think the last is
right,
very, very critical, especially on the international trade side, is compliance and regulatory monitoring, right? There are AI algorithms that can assist trade finance professionals in monitoring compliance, monitoring regulatory requirements, assessing potential violations beforehand, just by analyzing transaction data and conducting risk assessments, and flagging some of these suspicious activities, right?
right,
Adherence to AML norms, KYC norms, and other standards can also help you mitigate risk and some of the legal and reputational risks.
right,
I think we will continue to see the integration of AI in trade finance. This will continue to enable trade finance businesses and professionals alike to manage risks better, or improve operational efficiencies, and at the end of the day, I think they have to be business enabling and help you drive business growth.
right. Very rightly said, sir. So, as we move to the end of our session, I would like to have one key takeaway point from you, which you would like to advise the current traders or the upcoming traders. What key advice would you like to give?
Well, I think in my view, I think as business owners, and suppliers are obviously a one big community. But I think as business owners, we need to open our horizon a bit. Uh, I have come
Right,
across a lot of business owners who are also shy to talk about potential risks that they see in their businesses. Right. I know a
right,
lot of players in the segment struggle from not being able to access the suppliers or business owners or decision makers. I think it's high time, given the globalization and the complexities that come along with it. I think it's important that even small suppliers open up their understanding, engage in educational conversations, if not take a decision there and then, but at least understand from an education
right,
standpoint what are the tools available, like we spoke of, a lot of these aspects. I think small businesses
right,
should now enough access, but I think it is potentially some other reservations that hold them back. So I think business owners should become a little more open minded. uh, and one could assume that if this is the first time you're doing business with an institution, a supplier can worry about what kind of costs or hidden fees, etc., might be there. But I think if you speak enough about it, or speak to two or three counterparties, you can very well distinguish between the good players and the bad actors, right? So I think my advice
right,
to suppliers will be to keep an open mind, keep doing what is important to make sure that your business is adapting risk management strategies, and
right,
some of these sessions I'm sure will help. But even in the absence of some of these sessions, I think it's very prudent to potentially just go on the internet and understand some of the concepts that a business needs to take into account when deciding to do business. So I think that will be my advice.
right. So that was really, really great, and that was pretty much informative for me as well, and obviously for the audience. So, on that note, I would like to thank you, Mr. Jaspreet Singh Kanwal, for sharing your insights on factoring, trade finance, and supply chain finance. Today's discussion has actually shed light on important aspects of some important topics, and we hope our audience actually found it pretty informative. Uh, on that note, we would also like to invite to continue our conversation on our social media channels. So the audience is free to connect us on LinkedIn with Sir and with us as well, and we can like the audience can stay tuned for the future episodes. Remember, I would like to on that note, I would like to just mention one line: efficient liquidity management is key to navigating the complexities of the trade finance. So with that, sir, I would just like to thank you a lot for taking out time for this informative session, and we actually really enjoyed a lot having insights from you.
Thank you so much, Rajesh. Thanks to you and the entire India Factoring team, including Gauri. Thanks a lot, guys.
Thank you. So thank you for joining us, and we look forward to seeing you again soon. Till then, goodbye.